Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, welcome to Kaiser Watch.
Jim, pleasure to be back on the show.
John, how did the resource juniors do during the first quarter of this year?
Well, Jim, it's not so easy to assess how the resource juniors are doing these days. Now, in the old days, there was the TSXV Index, which the S&P created in late 2001, 2 decades ago. They started it at 1,000. It promptly went down. We were still in the BREX bear market that started in 1997, helped out by gold going down to 260 and base metals being generally soft. But then it started to take off in 2003, and it hit a peak of 3,372 in early 2007. That was a 237% gain. And then it sort of pulled back and kind of hung in there. And then in 2008, it dropped like a rock to 679 on December 8th, down 80% from the peak. But quite remarkably, when 2009 got underway, after a few months of stunnedness in the market and people like Rick Rule saying, this is the worst is still to come, copper started to go up. China came up with a $680 billion infrastructure stimulus bill, and we had another wave of a resource bull cycle, and it ran to a high of 2,465, up 263% again on March 7th of 2011 at PDAC Monday, 4 days before Fukushima hit on the 11th. And although gold didn't peak until August of 2011, the tipping point was right around then. And it went down relentlessly. Bottomed at 466 on January 20th, 2016, down 81%, another major retreat. And 2016 was interesting because then gold started to perk up again, and we had a bit of a rally, and that lasted until about late 2017 when it reversed course again. And then it managed to make 331 as a low on March 19th during the COVID meltdown. And since then, it has rebounded to 1,099, and this year it's down 6.1% at 893. So the question is, what is that index performance telling us? Well, during those first two bull cycles that pretty much ended 2011, 2012, the resource juniors tended to dominate the listings on the venture exchange and definitely the traded value. So paying attention to the TSX Venture Index, that was a good way to measure how things are going. But that started to change in 2012 when that big decade-long bear market began for the resource listings. That's when crypto, cannabis, other non-resource stories started to dominate the trading and financing activity on the TSX Venture change. And, one of the sort of dirty secrets about the index is that there were only always just a couple hundred companies in it, and that was about 10% of all the listings, and it was skewed towards the market cap weighted companies. And when one of them died and disappeared, they would just leave it in the index and add in a new one. And so the index was kind of falsely skewed on the upside and didn't really convey how the overall group of listings were behaving. But at this point, the resource listings are only roughly half of the index. And the other half is all these other different companies that have dominated the market in the last while. So it's really a waste of time to pay attention to the TSX Venture Index, because any day that it's up or down, or a week that it's been up or down, you don't know whether that's due to the non-resource listings having a good time or the resource sector listings. So I've given up using that as a tool. Now, I have two different tools that I use to home in on how are the resource listings do. One is since 2002, I have been classifying all the resource listings in terms of a 12 price ranges ranging from below 10 cents to over $10. And the ones that interest me the most are the below 10, 10 to 19, 20 to 29, and 30 to 49 cents, because bottom fishing, cheap stocks, companies that have yet to go up in a big way, that's what my specialty is. But I would track the percent of companies in these different categories, and it turned out that only the below 10 cents was a useful indicator over the long run. In 2007, when the TSX Venture Index was at its peak, only 4% of the listings at the time were trading below 10 cents. And during that crash of 2008, it rocketed to 53%, as almost everything just got sold out and people gave up. But remarkably, in that sort of 2.5-year run until sort of mid-2011, the percent had dropped back to 12.6%, reflecting the significant second bull cycle that we had post-2008 crash. But then, when that bear cycle kicked in, they reached a peak of 66% in early 2016, where we had that brief turnaround. And that turnaround was good, running until late 2017, and it dropped back to 33.4%. And from there it reversed and had a really good run, peaking at 53.7% in early 2020. And that's when I was thinking, I think we've got a trend going there. It's hard to really see it, but gold was showing signs of perking up. Eric Sprott had entered the market in a very big way in 2019, doing big financing in companies. There was a strong sense at the start of 2020 that things were turning. And then, of course, the COVID meltdown changed everything. That actually pushed it to that 54% peak. But the reversal that came after that was very significant, and it dropped to 22% in early 2021 after Trump lost the election, and the market was celebrating the clean energy transition, the potential for a global economy back on globalized track, which of course we now know is never going to happen again. But since that peak in early 2021, the resource listings have sunk back below the ones trading below a dime. They've sort of gradually increased to about 27.1% right now. So in terms of a trend, we are going in the wrong direction. If you look at this indicator, it would suggest to you, well, we haven't really had a good quarter. However, this is something of a lagging indicator, because the stocks below a dime usually have serious problems, and they are the last ones to wake up and drag themselves out of the gutter when the other companies are already doing well. And on the downside, when we're in a downtrending market, it takes the failed companies, they'll continue sinking, drifting lower, heading below a dime, even when the more substantial companies, after getting whacked in the market, have stabilized and are starting to recover. So this graph I find really useful in telling me the trend. It's not very good for showing the trend reversals, but you will be able to see in the next while if my argument that the resource juniors are actually having a very good time pans out. Now, the other method that I use a lot is traded value. And my data for traded value on the venture exchange goes back to 2000. But my ability to distinguish between resource and non-resource listings doesn't begin until 2009. And since then, I create this graphic where I stack the non-resource value traded on top of the resource value traded. And then I also plot the relative percentage of what value was dominated by the resource listing and what percent was dominated by the non-resource listings. And when you look at this, you can see the divergences, the big, long period. Interestingly, the 2009 to 2012 period, they were both roughly 50% jostling above and below. It was just looked like just white noise, but the divergence really begins in 2012, and they do not cross over again until that period in 2016, when we had what appeared to be a turnaround that was basically just a one-year turnaround. And then cannabis got back the ascendancy, and it wasn't until the late 2018 that it completely bottomed when the cannabis blow-off happened, when Canada legalized it, and everybody thought that would make things absolutely fantastic for cannabis companies, except the only problem is it shifted everything to, okay, now how much money are you actually making? How much are your sales actually growing? And so that whole cannabis winner-take-all psychology, that bubble peaked, and it's basically now just a showdown to see who the survivors will be, but it's tough to float a new cannabis deal and get any mileage out of it. Now, after the COVID pandemic response, and printing all this money and giving away all this money to keep everything from collapsing, we finally had a crossover for the resource juniors, a brief period from May until August, while gold went from $1,300 to over $2,000. That's when resource juniors dominated the scene. But by the time the new year rolled around to 2021, after the election, that's when we saw significant money go back into the non-resource stocks, and the resource juniors, they collapsed back below 50%, and they spent most of last year below 50%, somewhere between 30 and 40% of the traded value, while non-resource listings continued to dominate this. And this was pretty discouraging, watching this all of last year. Even though metal prices stayed high, gold was, $1,700 to $1,850 range, which was a lot higher than it used to be, and all the base metals stayed higher. So there was a disconnect between the high metal prices and the amount of money flowing into the resource juniors. But that began to change in the middle of December when the tables were turned. And since then, there have only been a couple days where resource listed traded value has been less than 50%. Some days it's been above 70%. Now, is this because there is new money flowing into the resource juniors? Well, no, the value traded has been relatively flat these last 4 to 5 months in the resource listings. What has happened is the resource value traded has started to decline. And that makes sense because you've got concern about general equity market decline as monetary policy jams up interest rates to deal with persistent inflation. You have the uncertainty created by the Russian invasion of the Ukraine in terms of what's that going to do to global trade and the economy, and even worse, to inflation levels. And so there's, and of course there's the, with interest yields going higher, you have the bond market going down, and people losing money just by having their capital in a much securer form than equities. So it made sense that there was turbulence in the non-resource listings, but it was interesting that the resource value traded continued to persist, did not decline. Because if you look at this scenario, it's all pointing to an economic downturn as a consequence of all these issues happening. And of course, when that happens, demand for metals goes down. If interest rates go to the moon and crush inflation, well, that's never good for the gold bugs who see the upside in gold lying in its role as a currency, as an inflation hedge. And so they really technically should have gone down as all of this was unfolding. And even though metal prices were surging higher as a result of suddenly Russia's nickel's not hitting the market, neither is its palladium, that should by itself just be viewed as temporary. But what it has seemed to have done is, even though there's an economic catastrophe looming on the horizon, the market is starting to warm up to the resource juniors, it's starting to do a cerebral thing of thinking, wow, if Russia and China stick with their alliance, if this problem with the Ukraine does not resolve itself quickly, if we end up with this divided, a new type of Cold War divided between autocracies and democracies, we're going to see the sanctions that the West is imposing now end up being counter-sanctioned when all of a sudden stuff stops coming from China. And China already, with its zero COVID strategy, is shutting down its output to the rest of the world. All the ports are snarled up, not because at the moment they can't get port workers to move cargo, but it's because all the truck drivers that are delivering stuff from the factories to the ports, they're suddenly trapped in all these shutdowns everywhere. I mean, they've got Shanghai, a city of 25 million people, shut down, and they think that this is going to stomp Omicron, which is more contagious than the earlier variants. They're all just vaccinated with a lower quality vaccine, different from the ones that were introduced by Pfizer, Moderna in the West, and its effectiveness and even with regard to severity, especially with older people, is not well understood. So China has a problem that can only get worse unless Xi Jinping capitulates and lets the virus run loose, kind of as is what's starting to happen here, where it's boiling down to a Darwin Award thing. You don't want to get vaccinated because you're afraid the vaccine will kill you? Well, you're a good candidate for a Darwin Award. You are getting vaccinated, okay, you're probably still going to catch it, but you're going to feel really crappy maybe for a while, but at least you're not going to end up in the hospital. This is now over here. It's boiling down to a Darwin Award situation. Who's a candidate? Who isn't? And the people who aren't candidates no longer care about those who are candidates. So this will just stick around and it'll bother us in waves. But China, with its absolute crazy desire to have it not be there at all, it may crush the global economy. So if Chinese stuff stops coming, this is going to create a big scramble in the West, and mobilizing new raw material from sources that are more reliable. That's the name of the game for the juniors. So juniors that are involved in non-gold metals, they're all going to get a big shot in the arm. It's not yet obvious to everybody out there. We're still in the early stages of this turnaround, but the resource juniors, the fact that money kept flowing into them even as it stopped flowing into the non-resource listings, that's telling you that the shift is coming underway, that even if we have some sort of economic downturn coming as a result of the higher interest rates, we may see persistently high metal prices that allow the juniors to flourish even in a recession-type situation. And that's conceivable because the total capitalization of the raw material producing sector in the world is a fraction of everybody else. So why shouldn't this sector be able to flourish if its role is to find a solution to this problem that all this stuff that we got through globalized trade is no longer coming from globalized trade? So my read of the first quarter was that it was good for the resource juniors. Obviously, it was selective because it wasn't across the board. The stocks trading below 10 cents have still been increasing. So it certainly isn't yet a market where all pigs are flying and everything that isn't suspended is going up. So it's a very interesting period. I've enjoyed the last quarter a lot. I feel good about this going forward, even as I'm watching aghast at what's happening on the global scene.
How did Resource Juniors do in terms of financing activity?
Well, this quarter was not as good as the first quarter of last year. Last year, the Resource Juniors men on the venture exchange managed to raise $1.9 billion. This year, they only raised $1 billion. And February was a really weak month, which is strange because usually, the first quarter is a big financing window. January was fairly strong and March was reasonably well, but February was like everybody paused. And of course, the Russia invasion was still dismissed as something that's, never going to happen. Putin's not so crazy that he's going to, mess things up for him in this manner. It was more the fallout from the tech slaughter, the general market retreat, the concern about persistent inflation, and so the general sell-off in a broad group of stocks that was limiting the money going in. Now, interestingly, last year the resource juniors traded $5.6 billion in the first quarter. This year it was lower, $4.1 billion. But when you contrast the non-resource sector, they only raised $1.6 billion in the first quarter of last year. And this year it's down to $745 million. So the non-resource stocks are no longer raising more money than the resource juniors on the venture exchange. And what's really interesting is in the first quarter of last year, the non-resource listings traded $13 billion worth of stock. That's compared to the $1.6 billion that they raised, for 4-month hold restrictions, some of it free trading right away. In contrast, this year they only traded $3 billion. So there's clearly what you can see in the financing activity is the capital is being allocated towards the resource juniors right now. We're seeing the value traded now in favor of the resource juniors. And in terms of the financial shape of the juniors, I've got the data up to September 30th financials, maybe October 31st, the December 31st financials, the year-end financials, which is 2/3 of the companies file in the December 31st year-end. That's still coming in another month, so we'll see what things really look like. And of course, this won't reflect the $1.6 billion that's been raised in, or the $1 billion that's been raised in this first quarter. But as of right now, all the data that I have for the venture listings, there's $5.3 billion in positive working capital sitting in these companies. That's 68% of the 1140 listings on the venture that I've got classified as resource juniors. There's $2.8 billion in negative working capital, money owed to others, sitting in 32% of the company, and you want to stay away from those. But there's about 1.6 billion parked in stocks trading below 29 cents. So these companies, these juniors that aren't blown up because they spent way more money than they raised, there's good pickings going on, and that's why I've been having a lot of fun with my bottom fish collection, seeing who has money, watching the ones deal with their warrants, get their warrants either exercised or have them expire so that the lid is no longer hanging over the stocks. The resource juniors are in reasonably good shape as we start the beginning of what I think will be a sustained resource bull market, with the resource juniors participating as on the heels of the bigger companies who are now waking up to the realization that 5 years of not developing anything, that's creating a situation where we are going to have to start mobilizing new supply, even if there is another recession coming in the next year or so.
How did your favorites do in the first quarter of this year?
Well, Jim, I have 8 favorites in my index that I introduced at the start of this year. The whole group was up 30% in late March. It's now up about 26%. That's compared to the TSX Venture Index, which is down 6%. and gold, which is up 7.7%. So this group has done quite well. However, reflecting what I was saying earlier about how it's not so easy to recognize that we're actually in a bull cycle for the resource juniors, it was split between 50-50 between the companies. So I'm just going to go through this list of 8 companies and just give a quick snapshot of where they stand. Aurion Resources started at $1.30. It's now $1.02. This is the biggest loser in my group, 21 and down 21.5%. They are a 30/70 partner with B2 Gold in Finland on a central Lapland gold belt, and they have the project where it's right next door to Rupert's Ikkari discovery, for which they reported a 4 million ounce resource last year. The structure trends onto the B2 Gold Aurion property. Last year, B2 Gold made the Helmi discovery, which was at the southeastern end of an 8-kilometer trend. They'd spent all their money to Vesta at the northern end and found the gold system, but not very much. This area is in a swampy area. They had only one drill, Aurion, which had raised a whole bunch of money last year. They have $25 million in the treasury. They said, okay, we have a rig, but we can drill in the summer. Let's give B2 Gold a rig. So B2 Gold has now 2 rigs beavering away while the ground is still frozen. At least 18 holes were done at the last report. We'll start getting assays in about a month or so. But the stock Aurion is kind of in this holding pattern at the moment. And although Helmi has good results, they are not yet comparable to Ikkari. So the speculation is, will Helmi reveal itself to be something similar to Ikkari? And while it may not be so easy to drill this swampy area in the summer, the B2 Gold's now come around to the idea, here's this 8-kilometer structure on our property. We've ignored the middle part because it wasn't clear where we should begin. Ikkari was found under overburden. It was a blind target that came to light with a geochemical anomaly and then grid drilling. So I expect to see B2 Gold, when they wrap up the Helmi area drilling, to mount a significant follow-up program. And then Aurion can go back to the Risti project and start doing more work during the summer. So I'm not at all worried about it being down 21.5%. They just did a big block trade in the past week in which almost 4 million shares were traded. This came from existing shareholders to accommodate a new institutional shareholder, somebody who isn't already long this stock, who liked the story, wanted in. They didn't want to finance at the current price because they already had all this money in the treasury. So now they attracted a new backer. So Aurion, I think, is one of the ones in this list that if you missed the boat on the others, take a look at that. Eskay Mining is down just a couple percent at 270. They took a hit in the past 3 weeks or so when they revealed the final results from last year's program. This year they're going to have a much more aggressive step-out drilling program. Last year they tended to focus on the TV and Jeff zones. Most of their drilling was concentrated on those targets, and those are sort of smallish. But the company now is in the midst of raising $7 million through charity flow-through at $3.15. They just reported finishing $2 million of that. They're working on the rest. And they're optimistic that a lot of the warrants that are cheaper, they're going to be exercised and they'll be well-financed heading into the summer program. But the stock hasn't really taken off yet because there was nothing really new in the final results when they were reported that the market hadn't already anticipated. And the next round of exploration won't begin until the summer. So this one's been kind of treading sideways. Galway Metals is a bit of a disappointment. It's down 11% at 54. They've been working for 4 years on the Clarence Stream project. They've reported a resource from the initial zones that they inherited when they acquired the property, but they discovered new zones to the south where they've been working for the past few years. The market at the moment is suffering fatigued from waiting for the resource estimate update. It wants to see at least 1 million ounces on the table so that an institutional type audience can start taking this seriously. Again, they've got a big district play. They've got sufficient money for now to carry on, but we need to see that resource estimate get published. And if you're optimistic that this will come in at 1 million ounce plus, ideally somewhere between 1.5 and 2 million, this thing also is a buy at this price, especially with gold. Gold really wants to break through $2,000 again. And if you're looking at the geopolitical scene, there's plenty of reason for that to happen. Northwest Copper, it's down 18.5%. That's the second worst performance in my group. It's at 66 cents now. They've raised plenty of money. They've got their feasibility demonstration work that they're doing at Quanica and Stardust. This year they're doing drilling on the Stardust. They just reported some results showing that there is a mineralization beyond the 421 zone where they put all their effort so far, but it's not yet big and spectacular and new enough to get the market excited. East Nib will be drilled later this year, but the stock itself, I think right now, is suffering because it's part of the Oxygen Capital Group, and it took a hit when Pure Gold Mining, its performance proved less than expected, and the stock has tanked down to 20 cents, and now all the class action predators are swarming, giving the company a bad time. They have done a significant financing to turn things around, but that is a bit of a cloud, even though it has nothing to do with Northwest Copper. The stock is languishing at the moment. So again, if you want copper exposure, this is not a copper producer. It is a combination copper exploration and feasibility demonstration story. It's a strong group in charge. They've got multiple programs going on this year. East Nib could blossom into a significant gold copper system. They got the evidence from last year's drill program, and copper's still hanging around at the 460-65 range. P2 Gold, it's up 7.4%, not much at 75 cents, but again, they're in the midst of doing the feasibility demonstration work on the Gabs copper gold project in Nevada. That's something that doesn't usually generate news that the market gets excited about. Where Ken and Joe are particularly excited is on the BAM project. The Monarch Gold Zone last year yielded intersections which gave them a better understanding of where they are going to be drilling. So this is in the Golden Triangle, and you don't drill there until July, so it's a summer drill program. But the upside potential for a significant sized gold discovery resides with the BAM, while at the same time as they continue to do the work on the Gabs, and as the market gets around to this idea that we need a lot more of these copper mines in North America, even if they aren't world-class Bingham Canyon scale. That's when you're going to start seeing the P2 Gold company attract a bigger audience. They had bad luck last year trying to attract institutional audiences. The Pretium that they were founders of, it's now been taken over and it's gone. So P2 Gold is in great shape, not up a lot, but with still lots of running room. Perpetua Gold, that has been the worst one this year. At one point, started the year at $6.03. It tanked to a low of $4.16 on February 24th. And I think the problem is the market has resigned itself to this idea that the permitting of the Stibnite project will never end. Well, now it's supposed to end sometime in 2023, so we'll see. But with the strength in gold and with the geopolitical problems emerging with the China-Russia alliance, the antimony byproduct credit is at some time going to wake up the regulators and say, yeah, we may not need another gold mine, but it would be really nice for the United States to have an antimony byproduct that's on our soil. And in fact, that was what kept us going in World War II in our battle against the Nazis of that time. We need to permit this thing, get it going, so that we at least have this antimony supply here. And it's more than we need for the United States, but there aren't a lot of other parts of the world outside of China and Tajikistan and Russia where there are meaningful antimony deposits. So we do everybody else a favor also by developing this, just in case the antimony supply from China and Russia and its sort of Stanley-related companies dries up. So again, this one, the numbers are great at $1,900 gold. If gold keeps going up, if you're optimist, if you were to believe that, a permit's definitely going to happen, the stock would be trading at double its current price right now. And the final one in our group, that's the superstar that's dragged up the return so that it's 26, 27%. That's Verde Agritech, started at $2.80 a share, peaked at $9.40 or so, is now $9.15, up 227%. It still has lots of running room. They were making progress last year just on the basis of the high fertilizer prices. But once Russia invaded Ukraine and the sanctions against Belarus kicked in, and Belarus justified them even more by teaming up with Russia to help them invade the Ukraine, then all of a sudden the world lost 40% of its potash supply, and the true crisis hasn't even hit yet, because the ships that were loaded are still delivering their cargo now, but pretty soon there will be no Russian or Belarusian potash available, and this has enabled Verde Agritech to double its capacity plans for its Plant 2 from 1.2 million tons to 2.4 million tons, plus they have gone full speed ahead doing the studying and engineering for a 10 million ton per annum Plant 3. The government's starting to wake up to this problem Brazil has with its potash import dependency, and it's only going to be a matter of time before they realize that we have this homegrown solution. It's an alternative type of potash. It's actually good for the Brazilian soil because it doesn't pound it with salt the way potassium chloride does. And the farmers, they're willing to pay the high price right now because with the Ukrainian crops not being likely to be planted this year and the Russian crops possibly stranded in silos, rotting and not getting to market, there is going to be hideously high grain prices, food prices, crop prices in the second half of this year. And so the Brazilian farmers want to make sure that they can mobilize all the crops that they can. And so, doing without potash for a year is not really good because they don't want to diminish their yield just because they want to save a few pennies, because they know they're going to get an enormous price for their crops later this year when they deliver. So I think Verde Agritech of this group, if it goes to $50 to $100, that's another 5-bagger from the current level. But it's the sheer numbers of this story that are staggering. The fact that you can look at the underlying fundamentals and say, wow, all of this makes sense. It's just a matter of time before big institutional money discovers this story and this stock breaks out and people start putting together all the numbers. And the company itself, it's working on a updated PFS. It's unclear when it will be ready, but when it will be ready, it won't be laughed at like the 2017 ones where they showed themselves growing from 0 to 25 million tons per annum over a 10-year period. Now people can see the reason why this is possible, and they're doubling their ultimate target to 50 million tons per year, which at the current potash consumption rate would be 63% of Brazil's current potash consumption. So Verde Agritech, unless something catastrophic happens in Brazil, that one I think will continue to be the predictable star performer from the KRO Favorites collection of 2022. And I'm working on a tin story and a lithium story, and we'll have those out available sometime within the next month.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.